Hello my fellow investors and welcome back to another stock analysis video. Today guys, we are going to be analyzing a company that was actually brought up by Lynette Solano, which pretty much just asked, can you do Christian Dior? Never heard of this company. I think it's French by the sounds of it, right? Dior. I don't even know if that's even how you say that. But nonetheless guys, I know nothing of this company, so let's actually come over here to Seeking Alpha and do a quick read on the company profile. It says, through its subsidiaries, engages in production, distribution, and retail fashion of leather goods, wines and spirits, perfumes, and cosmetics, and watches and jewelry worldwide. Okay, so they are pretty much like a distributor when it comes to I guess consumer discretionary things, right? So based off of that guys, let's actually now take a look at the company's fundamentals and their dividends and see if maybe at the current share price we would like to buy this company. So with that said, let's get started with this analysis. We are going to jump into the dividend summary guys. This company does pay out a dividend, which is kind of surprising honestly. Now looking at the dividend, we can see that, well, they don't have a yield, which is actually kind of surprising, though this is fairly easy to figure out. But nonetheless, the amount per share ends up being $5.07 for an annual payout of $10.84. That's a lot guys. Payout ratio doesn't have any, but probably because it is a foreign company. But we'll take a look at this in regards to the cash flow in just 1 second. The 5-year CAGR is massive at almost 23%, but they've only grown this dividend for 1 consecutive year. And in fact, if we take a look at the dividend history, we could see that, well, this actually isn't looking too good, right? Within the past couple years, they have been kind of iffy when it comes to this dividend. Obviously, they pay it semi-annually, so only twice a year, but nonetheless, you can see that it has been just all over the place. Sometimes they increase it, sometimes they don't increase it. They had a massive outlier year here in December 5th of 2019. I don't know if this was a special dividend or not, but $34.70 per share. That is absolutely insane, guys. So yeah, as it stands, when it comes to the dividend safety, I'm not necessarily liking this too much, but it is what it is. And you know, they may just be this kind of company that just pays dividends like this sporadically. Ex-dividend day is actually on December, so it is a little bit a ways. Payout day is actually on the 5th, and of course they pay their dividends semi-annually. Now let us come over here guys to the calculator. We got the ticker symbol of CHDRF, market cap of $113.8 billion. We do not have a PE, but I don't think that this is a case of a company not being profitable. I think it's just that Google Finance just isn't finding this foreign company, because as you'll clearly see in just 1 second when we look at their fundamentals, they're actually not doing too shabby. Now, current share price is $640. And yes, I did make sure that this was in dollars. If we actually take a look at Seeking Alpha, we can see that it says even right here, pink limited info USD pre-market. So, you know, this is in US dollars. And in fact, looking at the financials, if we scroll all the way down, we can see that all of the financials are also in millions of US dollars, except for per share item. So yes, everything that you're going to see here, guys, it is in US dollars. Now, taking a look at this annual dividends per share of $10.84. We can see that based off of the shares outstanding, they almost pay out $2 billion every single year. And now looking at the 5-year average free cash flow, we can see that after this dividend is paid, they're still left with, look at this, $8 billion. That's a fair chunk amount, guys. And as of last year's free cash flow, this actually doubles to $16.2 billion. That's fairly good. Looking at these payout ratios, they look even better, for last year's free cash flow being at 10.76% and the 5-year average not even reaching 20% at 19.76%. Pretty much just telling me that this dividend can be sustained and even increased in the future if they so wish to do so. Now let's take a look at some fundamentals. So, of course, with the net income, we got 5 years ago of $2.7 billion to 1 year ago, guys, of $5.6 billion, increase of 108%. And you know, I wasn't expecting this when I was looking at this company. Usually foreign companies are like not really that exciting. Take a look at this graph, guys. 5 years ago to 3 years ago, consistent increase, not that bad. Now, 2 years ago, they did go down to $2.4 billion. But guys, 2 years ago, COVID was happening. This is a consumer discretionary company. So you would assume that, you know, people weren't buying their fine wines or their jewelry or whatever. So this actually makes sense. But then right after that, guys, look at this. 1 year ago, boom, shot up to $5.6 billion. Now that is a massive jump from 3 to 1 year ago, but understand that there was a lot of demand pent up right around this point. So that's actually looking like a really good graph, guys, for the net income. I'm going to essentially ignore the 2 year ago number because of, again, COVID. All in all, I'm actually going to give this not 100%, but I'm going to give it a pretty good score, like 90%. You guys may even be inclined to put it at 95. If so, please do so. Taking a look now at the free cash flow, the most important of all the profit metrics, because this is the one that enables that sweet dividend of $10.84. This is the one that also, in general, just makes the company grow, make acquisitions, pay down their debt, buy back shares, etc. So it's very important, guys, for this thing to be positive and be consistently increasing. Now, looking at this, we got 5 years ago of 5.4 billion to 1 year ago of 18.2 billion. That is an increase of 234% with a 5-year average of $9.9 billion, essentially $10 billion, honestly. And this graph, guys, it's again looking really good. Every single year it has increased. Even during COVID, it increased from 9.5 billion to essentially $10.3 billion. That's actually not too shabby. Fairly surprising. Now, the fact that they did increase massively from 2 to 1 year ago, and also from 4 to 3 years ago, it is a little bit of a kind of issue right there. Again, I'm not going to put this as a perfect score, but it's not bad. It is kind of consistently increasing, and I kind of like these numbers. So all in all, I'm going to give this once again like a 90%. Looking now at the revenue, we got 5 years ago of 52.4 billion to 1 year ago of 73.1 billion. Take a look at this increase of 39.51%. Absolutely crazy. And once again, consistent increase year over year. We do see a dip 2 years ago, COVID related. I'm going to ignore it. And even with this decline in COVID, guys, they did bring it back 1 year ago, and it doesn't even look like that much of an increase from 3 years ago to 1 year ago. It was essentially an increase of around $13 billion. So it's actually not too bad looking at this graph overall. I'm actually going to give this the first 100%. This is looking really good, guys. So far, all the profit metrics are pretty much on par with everything that you want to see. Looking now at the total assets and the total liabilities, if we subtract them, we can pretty much see if the company will go under based on if their liabilities exceed their assets, which is something that you don't want to see. You want this to, of course, be positive, and you want this to be consistently increasing. Basically, the rate of assets increasing faster than the rate of liabilities. So we got here, guys, actually currently being around $52.7 billion. Now, this is increasing on the 5 year. However, we don't see a consistent increase. We see a couple of dips here and there from like 4 years ago to 3 years ago. Saw a decrease of around like $1.6 billion. And even today, we do see a little bit of a decrease of like a couple $1 million from 1 year ago to today. But this year isn't over yet, so they actually may surpass this 1 year ago value today. But I'm actually not going to give this, guys, the 90%. It is good, don't get me wrong, but it's just not consistently increasing on the past 5 years. Average total assets is around $114.1 billion. Average liabilities is almost $69 billion. And doing this difference, we got $45 billion. So I'm actually going to give this, guys, essentially like an 85%. I understand, you guys are saying like, this graph looks absolutely perfect. Why aren't you giving it higher? Yeah, I mean, I could give it higher, sure, but I just don't necessarily like this. So it is what it is. It is still a pretty good grade. And if you guys disagree with me, again, you guys could change it to like 90 or 95 to whatever you want when you guys use this calculator. But just because the assets do cover their liabilities doesn't mean that their cash flow can't. Now, we did see their cash flow, and it is increasing year over year, which is amazing. But as I said, cash flow is what companies use to pay down their debts. So let's actually do the same thing that we just did with the assets and liabilities, and I'll do it to the liabilities. If you take the cash flow year over year and the liabilities year over year and add them, liabilities are normally negative, add them, well, we can have a picture as to how much their cash flow is in comparison to their liabilities. And unfortunately, it's not looking good. As of last year ago, they're at $68.3 billion. And within the past 5 years, they have been going down. Now, full stop. They do have instances here that it looks like they are bringing it up a little bit, right? From 5 years ago to 4 years ago, it was a little bit of an increase of around $2 billion. And 2 years ago, around 75 billion. They did bring it up a little bit to 68.3 billion, but they definitely reached their lows 2 years ago, probably because of COVID. But then again, guys, 3 years ago, they went down even further from $40.7 billion 4 years ago to $55.7 billion. So yeah, it is what it is. They are getting further and further into the negatives, but you do see some instances where they are bringing it back a little bit. Average cash flow minus the average liabilities, we get around $56.5 billion. I'm actually going to give this, guys, a grade. I can't give this like a passing grade, unfortunately, but I will give it like a 50%, just because it does seem like they are getting closer and closer to zero, at least on the 2 to 1 year ago value and the 5 and 4 year ago. Now looking at the shares outstanding. Guys, this metric, very, very important and is very, very underrated. We want to take a look at this because this is what a company does to give the investor a bigger piece of the pie by the investor doing absolutely nothing, right? It is essentially the equivalent of a dividend. Some argue that this is actually better than a dividend because it just automatically grows the value of the shares that you already hold by default. Now, obviously, we want this thing to be decreasing, especially with this massive dividend. A company that issues a dividend, if the shares go down, their payout ratio also comes down with it. If they increase the shares, then the payout ratio also goes up. This company, however, is actually kind of surprising. 5 years ago of 179.8 million shares to today, guys, of 180.4 million shares. That is an increase in the 5 year of 1/3%. However, take a look at this, guys. Essentially, when they increased it to 180.4 million shares 3 years ago, they have kept it the same to today, which is actually kind of surprising. If we get 2 more years of this consistent numbers of shares outstanding, essentially their 5 year and their current will essentially be zero, which is actually kind of funny. So yeah, overall, I'm gonna have to give this, I can't give this like a really good score, but the fact that they kept it the same from 3 to today, you know, it's not that much of an increase as a third. I'm going to give it like a 75%. And now when it comes to the cash and equivalents, they currently hold $8.5 billion with an average of $11.4 billion. Now doing a quick overview on all of their fundamentals, we can see net income, guys, 90%, free cash flow, 90%, revenue was absolutely perfect, 100%, assets minus liabilities, 85%, cash flow minus liabilities, 50%, and the shares outstanding at 75%. Overall grade of 85%. This is looking like a pretty good company, guys. The issue is that liabilities, but as you can see, it's not that bad, right? They can't cover their liabilities with the assets, and on top of that, yes, their cash flow cannot cover it, but their cash flow is also increasing very, very consistently within the past 5 years. So now let us figure out if this $640 is actually a pretty good price to buy this company at. Gonna be making 3 different assumptions using 3 different factors. For the revenue growth, guys, the first factor, come over here to Seeking Alpha, we can see that the forward one, it's non-existent. I think this is because it is a foreign company. So I'm gonna lowball it here. I'm gonna say that for the low assumption, it is 3%. Median, let's go to 4. And for the high one, let's go to 5. Now for the projected share buyback, we have seen that within the past 5 years, it issued a little bit of shares at the 1/3%. Let's say worst case scenario that they'll issue at around 0.5% of shares in the next 4 years. Bring it to 0, which is actually the most likely scenario because they've kept it roughly the same within the past like 3 or 4 years, which is actually fairly surprising. And for the highest one, let's just say that they'll buy back shares at like 0.5%. Now we get some target share prices, guys. Low assumption, we get $829.62. Median, it is $863.43. And the high one, it is $898.38. Now adjusting for debt, this is where we take a look at the cash and equivalents as well as we input the net debt. If they have more debt than cash, then the value comes down, and if they have more cash than debt, then the value comes up. You can see it does come down by around $100 or so to now $724.46 for the low assumption. For the median, it is $757.74, and for the high one, it is $792.16. Now, adding a margin of safety of 5, 10, and 15% to this puts me between the buy ranges of around $615.80 to $688 for the low assumption. For the median, it is $644 to essentially $720, and for the high one, it is $673.34 to $752.55. Guys, the current share price is $640. So in one scenario here, we see that it is overpriced, and that is essentially this biggest margin of safety for the low assumption. But pretty much in everything else, guys, it's looking like it is a screaming buy right now. And in fact, this current share price pretty much puts me at the 15% margin of safety for the median assumption, which is actually the most logical thing that might happen because of the fact that they'll issue 0 shares in the next 4 years. They do have this habit. So taking that into account, this actually might not be too bad with this 15% margin of safety of 15% for the median assumption. Now, does this mean that you go automatically buy? Absolutely not. This is not financial advice, guys. Every investment is the present value of all future cash flow. And as I've been saying throughout this video, you guys can have this calculator. It's available for free. I encourage everybody to have it and to come up with your own weighted percentages, right? Come up with your own revenue growth assumptions, projected share buyback, required rate of return, margin of safety, etc. Because everything changes when you change these numbers. So it really just depends up to what you think this company will grow at in the next 4 years. Again, not financial advice. Every investment is the present value of all future cash flow. I also have, guys, the book value calculator, the re-evaluation calculator, and even a dividend tracking sheet for companies if you want to track your dividends. That's just so that way you don't have to keep logging into your brokerage account every single time. And on top of that, you can customize it to whatever you want, etc. So again, all I'm asking for in return, guys, for these free things is just help me grow my channel. Thank you so much for everybody who have subscribed so far. I really do appreciate it. Yeah, it's been a crazy experience with this YouTube thing. I mean, we're up to 1,029 subscribers. Insane, absolutely insane. I do plan on hopefully coming up with new series, talking to a couple friends. Maybe we could get some technical analysis videos, because even though I'm amazing at them, right? I am the best at them. I don't want to overshadow somebody else. I mean, I'm just saying, that's a hint, guys. I am terrible at technical analysis. That's why I've never done it. But yeah, but if you guys would like to see more of this, just help me grow my channel. Like, subscribe, comment. It really does help here with just everything. And yeah, I really do appreciate everybody so much. I just cannot believe I've reached this milestone. And I would just like to thank everybody for the help, because I could not have done it by myself, obviously. So with that said, guys, let's actually take a look at this company at the current dividends per share. Now, we do see that they are pretty expensive, right? $640. So based off of that, we're probably not going to get a lot of annual dividends. And again, their dividends aren't that reliable. But let's actually entertain this for a little bit. If you make the average monthly income $5,725, if you were to put in 1 month's income into this company, this will only get you 8.95 share. And again, this actually might be a pretty good price to buy that right now based on my assumptions, right? So take all of this with a grain of salt. But this would essentially buy you guys 8.95 shares. And at the current annual dividends per share at $10.84, this will get you an annual dividends of $96.97, quarterly dividends of $24.24, and a monthly dividend of $8.08. Now, also be careful when it comes to this, because this is a foreign company. And since they are based in France, there is a withholding tax when it comes to this. As you can see, dividends paid by French companies to individual residents in the United States are subject to 15% withholding tax in France. So yeah, guys, you're actually not getting this amount. You're actually getting withheld 15% pretty much per dividend payment. So it's actually not $96.97. It is a lot less than that, but they only pay it semi-annually. So yeah, take that information as you will. I think this is not the best company when it comes to dividends. That being said, though, their fundamentals are very solid. All in all, thank you so much for the stock recommendations. Always interesting to see foreign companies. And honestly, I was actually fairly surprised to see a company like this to have these good fundamentals. I know that sounds pretty, I guess, bad, but yeah, it's just like, I just wasn't expecting it. I really wasn't. Took me for a loop. Not the best company for dividends, and I guess you would consider $640 per share a little bit expensive, but not according to my calculator. So yeah, it is what it is. I personally am not going to buy into this company, but for anybody who wants to, their fundamentals are actually looking pretty good. That pretty much is it for this video. Like if you like, comment, subscribe. Really does help with the algorithm on YouTube. You guys can follow me on my new tech sites, link in the description below. Also guys, I did make yesterday a poll on my community tab about possibly changing the channel name in the future. So if you guys could go there and vote and just comment, tell me what you guys think about that, please, that'll be awesome. So with that said, peace out, and I will see you all in the next stock analysis video.